Good morning, everyone, and welcome back to another episode of Trade with Conviction. I'm Felipe Elink-Schuurman, and together with me today we have James and Jay. So, quite a lot of topics to discuss this week.
Yes.
Same as last week, and probably same as next week. There's so many things going on around the world. It's not just Iran, of course, but now the Houthis and Russia and Kazakhstan. It's like a nonstop. It's hard to keep track with everything that is going on. But despite all of this, I think we made some very good calls last week on crude, where we were saying that crude had to do a little bit of the heavy lifting here. And we're now seeing crude above 95, 96. On gasoline spreads in Singapore, they've rallied like there's no tomorrow, breaking any kind of moving average. I was looking this morning. So quite a lot of good things. Let's see if we can keep that track record two weeks in a row. So off to you, Jane, if you can give us a little bit of the headlines, what's going on around the world, why the world is becoming scarier by the minute. Tell us.
Yeah, definitely. The world is unfortunately becoming a lot scarier. And some of the things that we pointed out last week as things to keep an eye on, these things have actually transpired. And I think one of the main things that we mentioned last week, which is now front and center of everyone's focus now, is this issue with the Houthis. So just to give a quick recap of what the situation is, basically the Houthis have come out and said that they are giving a warning against all ships loading at Saudi Arabia's ports. And this is another level of risk now for the oil industry, for tankers, given how exposed the Red Sea loadings are for the global market.
Yeah.
As we know, when the Houthis crisis began, one of the key relief valves was the ability for Saudi Arabia to ship crude across a pipeline from Yanbu and then export it from there. Now, Yanbu is back front and center of everyone's attention. How easy will it be to get crude out of Yanbu if ships that are loading from there are essentially threatened by the Houthis? So what have we seen in the last couple of days? Well, we've seen a few mixed messages. We've seen some ships do U-turns. We've seen a couple of ships continue as they are, but prices don't lie. And we'll talk a bit more in detail how basically prices have begun to respond to that, up on freight, up on crude, and we'll give some more details about where we think the nuances are going forwards. Just want to stress here, when it comes to this risk with Yanbu, one thing that has been talked about a lot is the ability for Suez. So there's a pipeline that takes crude from the Red Sea in Egypt into Egypt on the Med side. That's already being used, and so whether that could be used more so, in short, the answer is not really much. So this once again adds to the risk and the fear and the panic in the market about how will crude come out if it's landlocked or this much risk. Zooming out a bit more at a more global level, like we can see essentially the MOU is dead now. We see attacks between Iran and the US continue every day. We've seen attacks on tankers. We've seen threats being made to infrastructure again on both sides. So clearly there's not really any indications of peace or even a cessation of hostilities anytime soon. In fact, probably Trump is considering all-out war as another option with Israel. We just saw recently a massive budget approved in the US, which is another sign ratcheting up the risk.
Yeah,
and then on top of all of that, we've got the latest issue with CPC and Kazakh oil. So no pumping going on. That's another 1.5 million barrels of Black Sea oil, which is crucial at this time, which is landlocked. So clearly a lot going on in the market, a lot to worry about, and the prices have reacted.
So let's take a moment, okay? So indeed, this morning, actually, it was not just a threat from the Houthis, but apparently this morning already they attacked a couple of Saudi vessels, I think the Layla and the Encilia. So it's no longer a threat, it's a fact. So let's look at the numbers. So Kazakhstan, you're talking about 1.5 million barrels a day. Again, maybe short-lived, probably short-lived, but that is a reality. I mean, when you think about Yanbu and those 7 million barrels that were transiting through Yanbu on crude, I mean, they will still transit, they will still be able to load, I guess, but they will just not be able to go through the strait. Or will they? I mean, that's can we really discount 7 million barrels of crude heading from Yanbu out?
No. So really what we have to think about is workarounds, right? So I touched on it a little bit. Yes, we could see a little bit more flow into Egypt, but not much more. I would say maybe at given rates where they are, somewhere in the order of 300,000 to 400,000 barrels a day extra could go in based on where I've seen the max flows for that. Really, the only other way to get crude out of Yanbu is for tankers to take the much longer route, i.e. load out and go north via Suez. A big if though, and that's assuming that those tankers, when they load from Yanbu, would be safe to make that journey from Yanbu up north. If they can do that, then the crude still gets there. It just takes a lot longer and it's a lot more expensive. If those tankers are attacked before they get to Suez, then we have a real problem.
Okay. So assuming that the attacks are focused on the strait, okay, so you cannot go south, you can load in Yanbu, you cannot go south or, the risky situation. You can go north and go through Suez with the limitations of the canal capacity, etc., because obviously you are putting in many more vessels, etc. Obviously, that's not necessarily very bullish for, the east-west kind of, European crude relative to east, or I don't know how you, Brent Dubai, I guess. Putting some pressure there, that's my first kind of reaction. But
sure.
on a refining margin as well for Asian refiners, and their ability to get this crude is threatened, or it will take a month longer to arrive. It seems completely insane. Yeah.
Agreed.
Those are my two first reactions. In the event that there is not, like a stoppage, you can still load, you can still transit, but you have to take another route, which takes you a month. That's sort of my initial reaction. So it's not like you're losing 7 billion, like at the beginning of the war, we were counting how many barrels we were losing. Here, you're not necessarily losing, but you're just delaying everything. Is that a good?
So yeah, I agree with you, Felipe. I think though there would still be some loss of total supply to the market if that route is taken, right? It's a lot less efficient, and I think logistically there would probably be at least some trimming from Saudi side of the amount of oil that's going through. If it's loading on smaller tankers, there are like physical restrictions in place to how quickly you can get crude out if you're not loading on a VLCC every time, right? So I think there would be some order of reduction, but yeah, it's a trim rather than a nightmare scenario, but still very, very expensive.
Yeah, you're right. And as you're saying, James, on the VLCCs, you can only expect those rates to skyrocket as you're going to need a much longer voyage and therefore less availability of vessels in the market.
Yeah, indeed.
I'm just reacting here. It seems a bit unreal, and I cannot see this as a sustainable kind of supply chain where you are loading from Yanbu crude that was historically loaded from the AG, and then it has to go all the way to the Med and then south, in order to get to Asia. So I'm just figuring out, and we haven't talked yet about all of the crude and diesel shipped from Russia that was going through Suez and through the Strait. I cannot pronounce the name. What is it again?
Bab el-Mandeb.
Yeah, exactly.
I mean, we've spent some time talking about crude exports from Yanbu, but it's not that small an effect for like diesel and jet exports from Yanbu as well, right? So we're going to have to see smaller vessels going there to load crude that would typically be loading products, I guess. I think also for like kind of LR2 Suezmax size vessels, we should see a real step up in rates as well.
Why smaller vessels? Because they cannot go through Suez with a larger kind of vessel?
Exactly, yes. Exactly.
Okay.
So you can only go through the Suez with a Suezmax.
So for a VLCC, if it's loading from Yanbu, it needs to at least partly discharge its cargo, which is one of the main uses for the Ain Sukna. So then they'll partly discharge, they'll go through the Suez, and then they'll pick up their cargo again from the Med side of Egypt, and then discharge at a VLCC destination port. So if that's not happening, then yeah, it needs to be a fully laden Suezmax or an Afra, for example. But yeah, that feeds into what James is saying about, from a tanker side, basically making the Suezmax Aframax segment a lot more tighter. And obviously in the Aframax case, that competes with the diesel pool to some extent. So it makes sense to have a look at what's going on with diesel, right, James?
Yeah.
Well, we'll talk about that in a sec, no? But before we move on, so there was also an update on Jody. I think I don't know if it was massively relevant, and obviously it's delayed. It's from May, but is there anything to learn from that, James, from the Jody report?
Yeah, maybe it kind of confirmed a lot of the thinking we'd had. So European diesel demand in May, particularly in Western Europe, looked really bad. France, Italy, Germany. Now, of course, there's always a caveat. There are some corrections that to come in Jody data that normally lifts it up a little bit, but the demand numbers look really bad. And that, of course, has been part of the solution during the first phase of this crisis, of course, demand destruction. Actually, European diesel stocks look pretty steady overall. Lower than average, but pretty steady. Crude did really tick lower. I think Jay's going to speak a bit more about that later. And I guess kind of the real thing that stood out, and maybe it's something that we've seen from the EIA stats before, is that as a signal, is that European jet yields have just been massive and just matching what we've seen in the US and globally in general. They've really turned the screw there to kind of fix this or help to solve partially this jet issue. You can see from the stats.
Interestingly, so yeah, I mean, so let's move on to your point of view based on these fundamental confirmation, if you want, from the Jody report, particularly on diesel and middle distillates. What are you seeing right now on middle distillates? What are what are the main topics? What do you think is going to happen? What is your opinion of the market?
Yeah, sure. Of course, it's such a, what would you describe it, fluid situation globally for distillates now. But apparently, the Russian fuel situation has stabilized to some extent, according to their government statistics. But as I think we say, we've got to wait and see on that respect. It doesn't really seem like Ukraine are going to give up or slow down these attacks anytime soon.
Well, it seems like a winning strategy so far. I mean,
Yes.
they're making a lot of noise. They're creating internal chaos. You've seen all the, YouTube videos of people fighting at gas stations in Russia and all that. That's creating internal havoc. And,
yes.
When you have a situation like that, why stop? You double down.
Yeah, well, it's interesting. I mean, when we kind of spoke about the start of this war, when we first spoke about this during the podcast, is that it was kind of definitively felt that Russia would win this attritional war. And it seems like Ukraine has, in some regards, kind of turned the tide a little bit on that. So it will be interesting to pan out, and it doesn't really seem like Ukraine's going to give up in that respect. As gas oil spreads have really jumped up, but to be honest with you, for distillates, particularly diesel, this really feels like the kind of worst-case scenario. I still think they're pretty undervalued. We've got the combination of the Mideast issues, the crisis, and the Russian situation on top of what we just spoke about, a potential shortfall of distillate exports from Yanbu into Europe, which is really kind of the baseload into Europe, really, for exports, due to the Houthis. We talk about the trade calls more, but I think there's still quite some positivity for gas oil spreads. Cracks have probably outperform spreads in some respect. They look extreme, and perhaps there's not so. I would say there's still an upside there, but maybe the risk reward isn't quite there as well. But fundamentally, they still go up, I think.
No, it depends on the positioning. If people were already long, and we'll talk about gasoline where the fundamental story is still strong, but the spreads haven't continued rallying because, again, you get to the point where you're already long and you're looking for new, fresh news or whatever. But in distillates, I agree with you. In distillates, the story, you are getting these fresh news. And now if you are a European and you need diesel, you don't have Russia, you don't have the Middle East and West Coast India kind of barrels because of the Strait. Yeah, you're getting into, you're heavily dependent on Gulf Coast or on delayed vessels coming through Africa. So that's...
Yeah, and I think that's an important caveat you point out there as well. I mean, the first phase of this crisis, prices really elevated. In some way, kind of efficiency gains, the market in some way kind of dealt with that. It feels like we're in a worse situation now than we were then. If you look at, like, for example, US diesel stocks, I think they've lost something like 20 million barrels from March to now. That buffer that they were kind of exporting to the world is essentially gone or really reduced. A big caveat to that, though, is, and what we saw at the first phase of the crisis, is the IEA making noises about the release of reserves, SPR releases for gas oil and for crude. That was part of the solution for the first phase of the crisis. So I think that's an important thing to pay attention to.
Yeah, I think that, so they came out with a message recently saying that we have plenty of stockpiles still available. So I think that's probably a precursor, a signal to the market saying, yeah, we have plenty available. So then eventually when it does come out, it isn't treated with as much scrutiny. I think it's just like the initial step before we get there. And I think we will get there where we see SPR releases again.
Yeah,
it's just
I mean, generally speaking, you see a relationship between SPR releases, Trump talking about, suppressing any kind of market spikes or anything like that. When you start seeing crude, which, is, not so much diesel spreads or cracks. No one talks about that ever. It's about crude. And we talked about it last week where people are positioning themselves on products because that's less of a potential suppression activity going on. But we said that crude needed to do a lot of the heavy lifting now because the cracks were at historical 10-year highs, etc. I don't think, other than this comment that you're mentioning right now, we are not seeing any kind of, I wouldn't call it propaganda, but press releases or anything like that around price suppression. We're not there yet on crude. So for me, there is still a potential for crude to continue doing their heavy lifting, getting above 100, which then influences what you're saying about cracks as well, James, where the spread activity on diesel may go up, but the cracks maybe not so much because crude is doing the heavy lifting, maybe. And only then when you start seeing crude at 110, 100, whatever, then you start seeing a bit more of political pressure, announcements of a new MOU, and announcements that, hey, the war is over or whatever it is, or SPR releases, etc. So I don't think we're there yet. I think that, flat price still has some room to go up. based on the new headlines that we're seeing right now.
Let's lead on from that. Let me kind of summarize the current status of arbs on distillate, and maybe that will roll into our trade calls as well. So Europe is increasingly, because of the narrowing of the gas oil east-west, which has been quite abrupt over the last 2 days or so, is increasingly losing out for West Coast India diesel barrels to eastern destinations, Singapore, etc. There's real fears in the east about, as we kind of alluded to earlier, about Asian crude procurement, and increasingly it seems like China's pulling away from maxing product exports, essentially, and that's particularly important for diesel and jet. Now, the US Gulf arb to Europe remains closed on the back of record strength in the HOGO. The HOGO has eased over the last, 2 weeks or so, mostly because of ICE gas oil ticking up. Still, US diesel stocks look really weak. And this is only being helped by the increasing pull from the US Gulf by Latin American destinations in the absence of Russian diesel exports, essentially, which we've already alluded to earlier as well. Our freight guys, actually interesting, are seeing TC14, the rally that we've seen in it, should slightly overextended, and we should see those rates drop, which should help to open those diesel arbs in the medium term. In the short term, they're very, very much closed. Actually, they're also seeing quite a tick up in kind of TC18, TC24 arbs into Latin America, because of that pull, because of the absence of Russian barrels as well. The same strength signals in the east are closing North Asian diesel arbs into Singapore, the city-state, as well as Chinese diesel arbs looking to be reduced as well. This is only going to add strength to the global distillate complex, not just the eastern one. So some of the trades that kind of flow out of that, I think the HOGO has to do more work in order to kind of find some more wiggle room in US inventories. Europe needs this diesel from US. So perhaps that's more a case of ICE gas oil pricing up than heating oil coming off, but we're going to have to see the HOGO. Now, the East-West, I'm a bit low confidence about this because of the reduced exports in East Asia. But we're going to have to see part of the solution that the East-West moves and widens again in order to pull these barrels west again. Europe needs this diesel resupply. I think there's a little bit, surprisingly, of bearish trade perhaps on global regrades. I think starting with US and Singapore regrade, I think we're going to have to start to see these weaken again to open up arbs into Europe for jet. Europe again needs this jet. I guess I want to add one caveat there, is that we're kind of coming towards the end of the European aviation season, essentially, as well. But yeah, I think overall, I think these regrades in the Asia and US should come off from here.
I think one thing, sorry, just on Disti, especially when it comes to East-West, the thing that I find tricky is East-West. And I think, like you said, James, HOGO is a much cleaner trade. With East-West on Disti, what you're basically trying to do is make a call on European Disti versus Asia Disti, but Asia Disti is also impacted by what we've discussed earlier with Yanbu, which is crude supply. So you're basically on the east side worried about crude and Disti, whereas on the west side you're thinking of a more Disti view. So that kind of muddies the water a lot more. I think HOGO is a much more like simpler trade and a higher conviction trade. So yeah, I'm glad we're still short HOGO so far.
When you think crack versus crack, so Singapore cracks versus European cracks, isn't there a play there? I mean, again, the simplest one is maybe sometimes just buying flat price, but I'm overcomplicating this. But it seems like there is a crack pool in Europe.
So I think there's also been part of the solution for that has been Russian refinery runs reducing in their Russian exports of crude. What that kind of signal is that part of that disconnect is that there's an absence of refining capacity now, right? We just can't turn this crude into products, particularly diesel and jet, to be honest.
Yeah, so I think the way I see it, it's much safer to be long gas oil cracks in Europe than it is in Asia because of the crude supply situation affecting Asia more, and also opinion.
You might as well go for something simple rather than something complex. So, the HOGO seems like a better alternative. What we were recommending was mostly, Singapore spreads because the impact would be immediate. What we've seen basically this week is that European spreads and cracks have pretty much stabilized. These fresh news that we're getting from the Strait with the Houthis is affecting obviously diesel and crude gasoline. And of course, in Singapore, the spreads rallied. And as a consequence, the East-West is pretty much following the Singapore spreads in sympathy. We've also seen that the gas naphtha has lowered over the last week, I think by $20, $25. This is more linked to, as I said, just gasoline steady. and naphtha rallying on the back of all the news that we're seeing right now. In terms of going forward, so what we can see is that for August in Europe, there is nothing there that would tell me, hey, we need to be massively bullish. And that adds to this sort of tension of why continue going long. There is no selling pressure from the spreads from E5 and E10. The blend margin there is absolutely negative. So I don't see anyone buying barges to blend and selling in the window. But at the same time, all of the arbs from Europe are pretty much closed. You have bits and pieces here and there like Ecuador, but that's pretty much it. But the interesting story comes in September onwards. When you look at September, October, November, the arbs are open from Europe into New York for refiners. So I would suspect some activity there from refiners hedging cargoes in advance. We also see that Europe takes back some of the shorts like Canada, Latin America, very tight on Mexico, very much at parity with Houston. So again, any traders now looking at locking in those cargoes going forward. And it goes back to what I was saying last week about, having a single region between Houston and Europe. So what you're seeing now is that Gulf Coast is doing the job. August should be dominated by the Gulf Coast, but that will drain the stocks over there and will allow for Europe to be retaking ownership of that. How do you express this? Maybe, selling the fly, selling the August, September and buying the September, October in Europe. When it comes to East-West, look, right now the trend is your friend. It broke, spreads and East-West broke every kind of moving average all the way from the 5-day to the 200-day moving average. So you can still, there's maybe you will have a relief and a little bit of bounce back, or, it goes down a little bit. But again, I wouldn't focus too much on East-West right now. I think that the Asian spreads, there's still momentum. On Europe, cautious, wait and see what happens. And it's more dependent on Gulf Coast. And if there's any kind of exhaustion there on stocks in the Gulf Coast, which means that you need to start buying back from Europe. Again, I wouldn't go short here on anything right now, but I would be cautiously optimistic in Europe. I think that you might see a rally in the Gulf Coast because it's dominating a bit the exports and the local supply. And on Singapore, it has done a massive rally. You could find yourself in a situation similar to Europe where it takes a breather, but right now, all the momentum is positive. That's my take on it right now. I don't know if you guys have any comments or questions.
I feel that the main comment here is I wouldn't go short anywhere. I think that's like a theme across the whole market right now, right? Whether it's diesel, whether it's gasoline, whether it's crude. And then the question is just, where are you most convinced that it's better risk-reward ratio to be long? And I think that's the tricky part right now.
And just to add to what I was saying before, when you look at on the east of Suez, Singapore is still the cheapest source of supply into Pakistan and to many other places. Theoretically, Gulf AG is the cheapest into East Africa, but probably only from Oman or Fujairah. How much of that volume can you supply? I don't know. So Singapore is still quite cheap into all these destinations, particularly for September onwards as well.
Yeah, another thing which I just thought now, thinking about Yanbu again, is just Yanbu probably supplies a decent amount into East Africa when it comes to gasoline. So that probably makes it more likely that whatever is there in Oman, Fujairah, stays in the East Africa region rather than heading further into Singapore. So another
100%.
reason to be tighter on the Singapore market.
Yeah, that's absolutely true. Yeah. Should we move on to crude, Jay?
Yeah. So, we talked a little bit about crude at the start, Yanbu, CPC. I just want to give a bit more detail and then flesh together my conviction or lack of conviction in some cases for some of the ideas that we have. So we mentioned, right, Yanbu, the issue is how will crude get out and right now it looks like it should get out, but it will get out in a roundabout way. What I think is good for us to remember is now we are almost in a reverse situation where we were a little while ago, where on one hand we were talking about all of these tankers coming out of Hormuz and creating a mini glut. Now we're in a situation where it could be the complete reversal of that, where we have this period of very, very tight prompt crude supply for a month or so if cargoes are rerouting around the Cape. And so we end up with prompt tightness and then a bit more normalization there afterwards. That could be something that happens, assuming this is a route that buyers take with their crude cargoes. That's only one option. Another option is just to buy crude from elsewhere to some extent, right? So for an Asian buyer, if you're not going to load or not going to take from Yanbu, then probably you're looking at WAF or TI. So with WAF, the issue is here that it's competing quite well into the European market. So it's not exceptionally cheap at the moment, but TI could be a good option, relatively speaking. Obviously, the VLCC cargo load size is helpful for Asia. And another thing I was thinking about is if Asian buyers are not going to take those Yanbu cargoes, then what crude would they be looking to from a quality perspective available? And Mars is probably a reasonable good shout. There's no ideal shout here in the scenario, but Mars is okay-ish. So maybe the scenario is they're looking to take some Mars and load it with TI and then ship it on a V to get to Asia. And that would still give you this issue where there is a mini supply shortage for a short period of time. But then when it does come back, at least it will come back in a grade which is more easier or more reflective with what you're taking in before. So that's one thing on the Yanbu side on fundamentals. On the other side, we need to look at it from Europe with the CPC issue. So this is tricky. And if this sustains, then yeah, what I said about WAF going into Europe, that probably gets even stronger with even more of a pull. One thing you mentioned earlier on at the start, Felipe, which I wanted to touch on a bit more, which is about this concept of maybe Europe being in a marginally better position than it was before when it comes to sour crude because of Yanbu. So what I mean by that is if there's crude from Yanbu, which is going into Ain Sukna, which is coming out from the East Med, and alongside that there's not VLCCs, but there's Suezmaxes which are loading from Yanbu, then that makes it a more palatable trade for European, especially Med buyers, especially if CPC is out. So one thing that I say, which is a little bit contrarian, maybe we could see some very, very short-term, relatively good value for maybe Arab Light in the Med. Those barrels will go very quickly, I'm sure, but maybe something to keep an eye out if you're on the physical side of things. When it comes to the paper trades, TI Brent, I think we still need to be more bullish Brent at this stage, given where things are with CPC and given the fact that it seems like a cleaner trade to make. If we look at Brent Dubai, I think the thing to look at here is an analogy of where we were maybe in March and what happened with Brent Dubai then when there was a real risk to Middle East supplies. And then we saw Brent strengthen quite a lot. And so I would say, even though some of that move has already happened in Brent Dubai, there is still a little bit more room to go. But rather than making conviction on TI Brent or Brent Dubai, I think probably it would be safer to be longer Brent spreads. And I know you may say, okay, well, Brent spreads have already done an incredible number in the last couple of days. Why are you going long? So to some extent, there's an element of the trend is your friend, but also if things really get bad, like if we look at where the front spread was for Brent, we're still a little bit away from that. So I think still that has some legs to go. Those are my main ideas on crude, but actually I'm more convinced on a trade on freight rather than crude at the moment. So the trade on freight, which is related to crude, I think is probably a better return versus risk reward here. And I think this goes back to what we've been discussing around the potential for ships to load in smaller sizes out of Yanbu, the potential for increased competition with diesel and crude on Aframaxes. And so I think actually one of the biggest opportunities here is exposure to Suezmax rates. Suezmax rates in particular, TD20, WAF to Northwest Europe, I think that could potentially be a route which has a lot of appreciation to be made. We've already seen some gain, but yeah, I still think there's legs on that. If there is difficulty in the liquidity side of that, then I think even a more general view of being longer TD3C makes sense. This whole issue of Yanbu, of Houthis, it's all adding inefficiencies into the shipping world, right? And the easiest, simplest way to express that is probably TD3C. So I think that's a pretty sensible thing to put on.
Yeah, very interesting, yeah.
Yeah. No, I agree. Sometimes the better trade is the one in front of you. And in this case, it's freight, so good call there. Let's see. Well, good call for the moment. And so I think this is it for us right now. A lot of new developments. Let's keep an eye on freight, on flat price, on diesel spreads, on HOGO. I think that's where most of the action is right now. And I would say, and on NAFTA, we haven't talked about NAFTA, but obviously NAFTA is very impacted. Maybe something for next week to bring up. Thank you very much, guys. Good to see you all. And we talk next week.
Yeah, thanks to you too.
Bye.
Thank you.